Welcome to Quick Invest Brief. In today's Quick Invest Brief, we're diving into exchange-traded funds, or ETFs, to give you the powerful insights, briefly told, that you need to navigate the world of investing and build real wealth. Let's get started. First, let's understand what investing really is. It's not just about getting rich quick, but rather about putting your money to work for you. It's about strategically placing your capital into various assets, aiming for growth over time so you can build significant wealth for your future, especially for a comfortable retirement. While traditional savings accounts offer minimal returns, investing allows your money to compound, creating a powerful engine for financial growth. Think of it like building a snowball. You start with a small amount, roll it consistently, and over time, it grows much, much larger. This applies to various assets like stocks, bonds, gold, and even more speculative ventures, though we'll focus on a powerful broad option today. So, what exactly is an ETF? An exchange-traded fund, or ETF, is an investment fund that holds a collection of various investments. It could be hundreds or even thousands of stocks, bonds, commodities like gold, or a mix of all three. Instead of buying individual shares of, say, 100 different companies, you buy one unit of an ETF, and that single unit gives you exposure to all those underlying assets. They trade on stock exchanges throughout the day, just like individual stocks, making them incredibly easy to buy and sell. The key here is that an ETF aims to track the performance of a specific market index, like the FTSE 100 or the S&P 500, offering a simple and low-cost way to get broad market exposure. Now, why should you consider investing in ETFs? Whether you're a complete beginner or a seasoned professional, ETFs offer compelling advantages. For beginners, ETFs are fantastic because they offer instant diversification. This is crucial for managing risk. Instead of painstakingly researching and picking individual stocks, which can be risky if you're new and puts all your eggs in one basket, an ETF immediately spreads your investment across many different assets. This significantly reduces your risk, as the performance of one struggling company won't derail your entire portfolio. It's like buying an entire grocery store instead of just one type of fruit. They are also generally simpler to understand and manage than a portfolio of individual stocks. For experienced investors, ETFs provide a highly efficient way to gain exposure to specific market sectors, regions, or asset classes with low costs and high liquidity. They're excellent for implementing various investment strategies, from long-term core holdings to tactical allocations, allowing for precise control over your portfolio's exposure. Thinking about a comfortable retirement? ETFs can be your best friend. By consistently investing in broad market, low-cost ETFs over many years, you harness the incredible power of compounding. How much should you invest, and for how long? The general advice is to start as early as possible and contribute regularly. Even small, consistent contributions can grow into substantial sums over decades due to the magic of compound interest. A common guideline is to aim to save at least 15% of your income for retirement, but truly, any amount you can consistently invest will make a difference. The longer your money is invested, the more time it has to grow, letting compound interest work its magic. For example, investing $100 a month consistently from your 20s can lead to a significantly larger pot than starting in your 40s. When choosing ETFs, always keep an eye on fees, also known as the expense ratio. Lower fees mean more of your money stays invested and works for you. Your goal should be to find a reputable fund company and select a low-cost passive fund or ETF that aligns with your investment goals. These types of funds simply aim to track a market index rather than actively trying to beat it, which often results in lower fees and consistent performance. So, why are ETFs often a more appealing choice than picking individual stocks, especially for long-term wealth building? Beyond the instant diversification we've discussed, it's about simplicity and time efficiency. Researching and monitoring individual stocks takes significant time, effort, and expertise. With ETFs that track broad market indices, you essentially set it and forget it for market exposure, allowing you to focus on other aspects of your life. While picking individual stocks can offer higher returns if you choose correctly, it also comes with significantly higher specific risk. Most individual investors simply don't have the time or resources to consistently beat the market by picking stocks. Beyond traditional stocks and bonds, which are the main components of many ETFs, remember there are also alternative investments like real estate or commodities like gold. For younger investors with a higher risk tolerance and longer time horizon, a small allocation to more speculative investments like certain emerging technologies or even cryptocurrencies with proper research and a deep understanding of the inherent risks could be considered, but always as a small portion of a well-diversified portfolio. The core of a strong, resilient portfolio, especially for building wealth towards retirement, often lies in diversified, low-cost ETFs. Don't miss our next brief. Subscribe now to get more powerful insights, briefly told, delivered straight to your feed. Have questions or want to share your view? Leave a comment below.